Now we are going to dive into the world of bonds and how macroeconomic conditions are affecting not only the US Treasury market but also here at home. Joining us now is James Wilson from Jamieson Coote Bonds to discuss what's happening with the US Treasury bills, something that probably all investors should get their heads around just a little bit this time, and also the latest RBA minutes we have from the May meeting. James, welcome to the Pulse this afternoon.
Good afternoon, how are you?
I'm good. So we were going to touch on what's going on in the Treasury market overseas in the US. And I was just having a quick look, those 1 month Treasury bills, and we should have a chart that we can pull up, have basically the yield on them in the last month has gone from under 3.5% to 5.735%. So maybe you can shed some light. What is going on here?
Sure. So there's a lot going on at the moment at the very front end of the T-bill curve. So we're approaching what is known as the X date, and the X date is the day that effectively the US government almost runs out of money and is no longer able to borrow anymore. And so what that means is, that the T-bill is one of the most liquid instruments in the global interest rate curve. And as you can see by the chart that we just had up there, the 1 month T-bills, so out to in the order of May, are looking quite well sought after. There's been, as the X date approaches and the government can no longer issue debt, that makes the yield go lower as the price goes higher. So there's huge demand for that, and you can see that's close down to 3%. Once we get to the X date, which is where the government is expected to run out of borrowing capacity, which is early June, that price, the yield on that T-bill spikes higher, because it's going to get to a point where there becomes a danger of, well, first of all, you're not getting your money back when you're as an owner of the T-bill, and also a huge borrowing program that the US government will have to issue at that time.
Right. So in terms of, if we're looking at the debt ceiling and all the machinations, and obviously there's lots of conjecture about whether or not we're going to go down to the wire a la 2011, what kind of volatility in the bond markets could we see as we get closer to a potential default? I know I was reading about strength in the US dollar, ironically, but would the disparity between longer dated bonds and the short dated end become even greater?
Yeah, that's right. So the biggest impact, I guess if you look at what the probabilities are of a default or what will happen in the next few weeks, I guess the scenarios are that we get a long-term agreement, which is where we get the debt limit suspended, longer-term deal along the lines of the most recent Republican bill. We see that as in the order of about a 10% chance. There's a short-term compromise, which is what does seem to happen most times when we see these things come along. Got to remember that we've seen since 1960, I think 78 times there's been a raise of the debt ceiling, and then the result that no one wants to see is no agreement and a default in the US debt. And that would be a disaster for financial markets. That would see services shut down. That would see Social Security shut down. What we saw, a few years back, we saw a partial government shutdown, and in the worst case scenario, we're seeing interest payments not being made on government debt. Now, if that does happen, that could result in the order of millions of jobs being lost, because it'll be harder to fund the US debt. We won't see buyers, and it'll have severe damage to the overall US and global economy.
Maybe taking a different tact then, as a fund manager, when you're investing in US Treasuries and Australian Treasuries, how do you manage the risk moving into this type of situation?
Well, I think there's a lot going on in global bond markets at the moment. We've come from a very high volatile period through March when we saw SVB blow up, and there was a weekend there around the 7th or 8th of March when we saw the US 2-year Treasury yield move 100 basis points in the weekend as SVB did crash. From there, we've managed to sort of find our feet a little bit more so, and the volatility on bond markets has dropped dramatically, and so April saw a much lower range in government bonds, and we've come to a moment in treasuries where things are really starting to coil. So, right now, we see fair value at sort of 3.5%, and from a fund manager point of view, we'd probably be looking to add duration somewhere around 4% and go short duration somewhere around 3%. If you're looking at the two big levels, and I guess when we look at those things and we're in these coiling situations, we're looking for drivers that are going to get us to either end of those ranges. And on the long side, you've got things like the continued US bank issues. You've got the debt ceiling not being solved. You've got the growing concerns about global demand, and which is evident in the commodity price action. So the copper gold ratio has collapsed to multi-year lows. The continued liquidity drain, and then you've got things like inflation. The US inflation level finally dropped to see a 4 handle for the first time in over a year at the last reading. Then on the short side, the risks that we see there is things like the Bank of Japan removing the yield curve control, which is a non-zero risk in the upcoming June meeting. You've got if there is an early resolution of the debt ceiling, that's going to get the market moving to higher yields. Then you've got if they guaranteed bank deposits, if we see geopolitical developments, could see a washout higher. And then just overall, there's the continued hawkishness as inflation levels, although they are coming off from very high levels, they're still at uncomfortable levels for central banks. So they're going to keep the hawkish language going. And even this week, we've got 14 different opportunities for Fed speakers to share their knowledge. And one thing that does add, unfortunately, is even more volatility to the market. So we're just looking for better levels to be in from either side.
Wow. I was about to say, is that all? There's so much going on at the moment. It feels like, I don't know, I'm no bond specialist, but it looks to me like 2023 is really the year where there's a lot going on in bond markets. So maybe if we shift to those RBA minutes, the May minutes that came out today, did you read that as an unexpectedly ongoing hawkish tone that has come out of those minutes?
Look, I think it was they tried to be fairly balanced, and they did note that the difference between a pause and the 25 surprise hike was a balanced decision. I think that the point is, they're coming out of the RBA review. They're trying to keep their own credibility, and they've got an inflation rate, although it is backward looking. A couple of months sitting at with a 7% handle, for a headline number, and you just can't keep the cash rate at 3.6 and not be looked to do something to maintain credibility that they've been struggling a little bit over the last year or so, ever since the yield curve control unwind. So from that point of view, the other thing they mentioned was the housing starting to creep higher, and they just want to be committed to price stability. So I don't think you can rule out any further hikes, but from our point of view at JCB, we do see that there's potentially one left in the system, but we'd be pretty confident that we're done for the hiking cycle for now. The one thing that did pop up that probably will get a bit of attention is they opened the door to start being active selling of their bond portfolios. So quantitative tightening could come in into the vernacular and into the meeting discussions, the next few meetings. And then just finally, looking forward, with the next meeting, the June meeting. The 4 big points of data to look for will be the wages number, which is going to be extremely important, which is on Wednesday, jobs numbers on Thursday, retail sales next week, and then monthly CPI on the final day of the month.